Hey everyone, welcome back to Corporate Decoder, the place where we unpack the financial jargon so you don't have to. And today we're diving into C1 Fund Inc. Their latest filing is a real eye-opener, especially if you're curious about the wild world of digital asset investments and the companies trying to ride that wave. So before we start, if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below where we break down more of these filings. C1 Fund Inc. is getting ready to go public, aiming to raise quite a bit of money by selling shares of its common stock. They're planning to invest in a select group of 30 private companies focused on digital asset services and technology, excluding those primarily run out of China. It's a pretty concentrated bet on a very specific and, let's be honest, pretty volatile industry. The company itself is a new player formed in August of 2024. They're a closed-end investment company, which means they raise money through an initial public offering and then invest that money to generate returns. Unlike open-end mutual funds that can create new shares to meet demand, closed-end funds have a fixed number of shares trading on an exchange, and their market price can often swing differently from the actual value of their investments. Now, let's talk about some of the immediate costs. For this offering, there's a sales load of 7%. If they sell all 6 million shares at $10 each, that's over $4 million going to the underwriters. They also mentioned some pre-offering fees to Benchmark, the main underwriter, for their work in assessing the offering. After all those sales loads and other offering expenses, which are estimated to be around $1.37 million, the company expects to net over $55 million from this offering. This money will then be used to make their investments. And when we talk about risks, C1 Fund Inc. doesn't shy away from telling you what could go wrong. They're upfront about the volatility of their stock price and the significant risk that it could drop quickly. There's also the strong possibility that their shares could trade at a discount to their actual value, which is a common issue with closed-end funds. A major point is their lack of limits on investing in illiquid securities. This means a big part of their portfolio could be tied up in investments that are hard to sell quickly, which can be a real problem if they need cash fast. Their investment objective is pretty simple: maximize total return. But as you can imagine, achieving that in the digital asset space, especially with private companies, is a massive challenge. They're relying heavily on their investment advisors, C1 Advisors LLC, and its investment committee. And here's a crucial detail: they have no operating history as a closed-end investment company. This, combined with their non-diversified approach, means they're really putting all their eggs in a few very high-risk baskets. If even a few of those digital asset companies stumble, it could have an outsized impact on the fund. This is a big one they highlight themselves. The success of this whole venture hinges on the advisor, who, to be blunt, has no prior experience managing a registered closed-end investment company. That's a significant gamble. The key players on their investment committee are well connected in the venture capital and digital asset world, but managing investor money in a regulated fund, especially one focused on such a dynamic sector, is a different ballgame. They are primarily targeting private companies. This means less public information is available, making due diligence harder and increasing the risk of unexpected problems. Private companies are also often less financially stable and more dependent on a small management team. Their main strategy is to invest in equity and securities linked to equity from these private digital asset companies. They're looking for companies that are at least valued at $500 million and show strong growth and financial health. They do due diligence using various factors like market size, growth rate, and competitive positioning. Let's glance at the current financial snapshot as of June 2025. You can see their total assets are pretty minimal, around $1.4 million. Much of that is in deferred offering costs, meaning money spent getting ready for this IPO. Their cash balance is just over $100,000. Their net assets are a mere $100. This is essentially the seed money they've raised. Remember, this is before they've actually gone public and raised the bulk of their capital. It shows they're still very much in the setup phase. Looking at their statement of operations for the period from their inception in August 2024 to June 2025, you'll see they had virtually no income and their expenses were fully reimbursed by the sponsor. This is expected for a company this early in its life cycle, but it highlights that their real performance will only start after the IPO. The risks associated with the digital asset industry itself are a huge focus here. They talk about extreme volatility, disruption, loss of confidence, and a lot of negative publicity in the digital asset space. Examples like the collapses of Celsius, Voyager, and FTX are mentioned to underscore just how risky this sector can be. They also address the fraud and manipulation risks specific to digital asset markets, such as wash trading and hacking of platforms. Given the rapid pace of developments and regulatory scrutiny, these are significant concerns that could impact their portfolio companies. They might invest in companies that use decentralized finance or DeFi protocols. The risk here is that these protocols are new, largely untested, and could malfunction or be exploited, leading to losses for the companies C1 fund invest in. Ultimately, they can't guarantee any returns. All their investments are subject to market conditions and the performance of the companies they back, over which they have no control. Looking at the leadership, the management team, particularly the interested directors like Najmul Hassan Kidwai, Michael Lempres, and Michael Zhao, have significant backgrounds in the digital asset and tech space. Michael Lempres, for example, has served in high-level roles at Coinbase and was on the board of Silvergate Capital. Their experience is a key selling point, but as we noted, it's their first time managing a publicly traded fund. The independent directors are set to receive a decent annual compensation, which could increase if the offering is substantial. This is pretty standard for independent directors overseeing a fund. To wrap up, C1 Fund Inc. is making a really specific bet on the future of digital asset technology companies. They're going public with a strong management team in terms of industry knowledge, but with significant risks due to the sector's volatility, the companies being private and illiquid, and the advisor's lack of prior experience in managing a registered fund. It's a high-risk, potentially high-reward scenario, and investors are being warned upfront about the potential for significant losses. What's your take on this concentrated bet on digital assets? Are the management's connections enough to navigate this tricky market, or does the lack of experience and inherent sector risks make this a pass? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives like this. Don't forget to check out the Discord in the description for more insights and discussions. Thanks for watching. See you next time.